if it takes this long to do a business valuation for SBA, why are we saying 10 business days? It's like you're working on it for a couple hours each day. What happens if you take that and concentrate it in a shorter time frame and are able to work on it in 3 to 5 hour chunks per day? And it's like, oh, if that's possible, you could do a lot. And so when I entered the space, I'm like, 5 business days.
Welcome to the Before You Buy or Sell a Business podcast, where we help buyers and sellers learn more about the acquisition process, discuss recent transactions, and stay up to date on the latest news in the market. Here's your host, Jared Johnson.
All right, so today I got Ryan Hutchins with Peak Business Valuations. How you doing, Ryan?
Oh, doing good. Thanks, Jared.
Yeah, it's getting cold out here in Salt Lake.
Oh, it feels normal. Feels good.
Feels normal, feels good. So, all right, well, love working with you on our projects and doing our business appraisals, valuations. Maybe we can start and just find out a little about your background, where you grew up, your college education, all that fun stuff.
Yeah, so background-wise, I'm originally from the Bay Area in San Francisco. Went to school at BYU here in Utah, studied finance, went to Santa Clara, studied accounting, thought, why would I get an accounting degree? And so instead I took a 3-month, 33 semester credit certification in accounting. So new class every 8 days.
Oh my gosh.
Went to Deloitte, got my CPA, learned I did not like working 80, 90 hour weeks. And went to a business valuation firm where they only expected me to work 40-hour weeks and thought, oh, that's nice. What do I do with my remaining time? So instead, between like 5 a.m. and 8, I studied valuation theory, which is very entertaining. It's like reading Lord of the Rings, but not. And I progressed at that valuation firm to the point where I was taking over the annual operating plan, selling and fulfilling, and realizing, oh, I should start my own valuation business because this current company focuses on 30 valuation project engagements, and I really just like working with small business owners. So I left, started Peak in August of 2018, and my main focus was small business owners, and the primary referral source is SBA lenders when it comes to valuing small businesses. So landed my first project valuation engagement in November 2018, and today we now do roughly 1,200 business valuations a year for individuals buying and selling businesses, for SBA lenders, for individuals doing gift and estate tax planning. And then we have an array of other services that I never thought I would get into, but when you get an inquiry every week for quality of earnings, you're like, I should do that.
Yeah. So did you study that at 5 o'clock in the morning as well?
I did not. No, I got to a point where I needed to hire someone who actually knew what they were doing in that space because I didn't want to learn it.
Yeah. Wow, that's great. So 1,200 a year. So when you started, did you have a goal in mind of how many you wanted to do per year?
My whole goal was to make $250,000 a year.
Okay.
And just work by myself and have a nice life.
Yeah. Well, I think you surpassed that. So that's great. So, and then I think since then you've also acquired some businesses, right? You want to talk about that a little bit?
Yeah. So in May of 2021, I did an SBA loan through First Internet Bank for a water softening company in Park City, Utah. And the reason why I did it is, one, I had a buddy that sold 4 Freedom Boat Club franchise locations in Virginia and made money. And I was like, hey, I need to put this capital to work. And because we value individuals' businesses that are looking to sell, they will have someone intended to buy their business. And if it falls through, they will typically come back to me and ask, hey, do you know anybody else? And this particular business owner kept coming back to me every 6 months and kind of complaining about the key employee that was going to buy the business, and finally fired him. And then I said, I'll buy your business since he's not a part of it. So we bought the business because I wanted to learn about SBA financing and the whole process on the other side of the coin, which it is a very long process. So it's good to have a good, smart BDO kind of holding your hand through the whole thing. And so bought that business in 2021, bought a concrete contracting company in 2022. And this year we've invested and partnered. So instead of buying the businesses, we found that it's more effective to partner with individuals who are going to operate it. So we own a minority stake now in the companies, but we provide them mentorship, resources, and our relationships. And we now own a striping franchise territory in Salt Lake and Utah County. It's with a company called 1-800-Striper. It's a new franchise out of New York. I'm pretty sure you're going to be seeing them a lot.
All right.
Because we've chatted with the franchisors and explained to them that they should just have someone that they refer all their buyers to.
Well, let's go sit down with them.
And then we're looking at a Steelmasters franchise and a fencing company to acquire.
Yeah, so you're just going to keep going with it, I guess.
Oh, it's fun.
Yeah,
it's just a game.
You went from not wanting to work 80 to 90 hours a week. So what are you doing now? 120 or something? Went the other way with it. So
yeah, schedule wise, I'm very different. I wake up at 3 a.m., start working immediately. Then I take a break and work out and do all my other morning routines, and then pretty much work until 5 and work on the weekends too.
Yeah, no, I think it's a wild world that, you know, small business finance is, especially the key people that are doing the volume. People always think like, oh, they just work at a bank. They hang out, they get holidays off and stuff, and they don't realize how much work goes into it and stuff. So, wow, that's 3 a.m. Well, at least I know when to email you now, so I'll reach out to you at that point. So, I mean, you kind of walked me through it already, but as far as learning the valuation theory, at what point do you have to get the designations? Maybe you can talk a little bit about what goes into the designations, what they mean, you know, which ones you carry, and kind of how that works in your world.
Yeah, so there are several different designations. The first one that I received was called the Accredited Business Valuator, and that was through the AICPA, which is the same organization that issues CPA license.
Okay.
So because I was a CPA, it was that much easier to go down that path and get that designation. And what it required was X amount of valuation engagements, which I was the primary lead, and then 2 tests that I needed to study for and pass.
So with that one, is it more focused on M&A, like larger transactions, or is it all the way from real small?
Yeah, so it covers the whole breadth of valuation. So when studying for these exams to get the credential, it's all the way from teaching you the history of business valuation to code to ethics to how you actually go about performing the business valuation and then the various types. So there's nothing really specific about it. The other designations that I have, the primary organization is the American Society of Appraisers, so ASA, and they have a designation titled the ASA, which I did all the coursework for, turned in a valuation report, and they wrote back and said, you need to include this valuation approach, this valuation method, X, Y, and Z, and said, this is junk. And I'm like, oh, this is great. I put in SDE multiples, and they're like, what's an SDE multiple? And what I learned is there's a vastly different perspective from larger companies to small businesses. And so for them, I had to put together a new report, which it's been 3 years and I still haven't put it together. But I need to look at public company transactions and public company data for multiples instead of looking at private transactions, which is all you need to look at for small businesses.
Right. So it doesn't really apply to what you do. So
no, it doesn't apply.
Haven't been focused on doing it. Yeah.
Yeah. It
makes sense.
I haven't gone through it, but we've recently hired an individual that has 25 years of valuation experience and performs trainings for others, teaching them about business valuation. And he's like, oh, this is what you need to do to update your report so it's up to snuff for the ASA.
Oh,
I'm like, oh, that's awesome. But ASA came out with a designation for those who didn't want to submit the report called an accredited member, so AM.
Okay.
So I have that by default.
Okay.
The last main credential in business valuation is called the CVA, so Certified Valuation Analyst through the National Association of Certified Valuation Analysts, so NACVA. And that is primarily the one that almost every valuation professional now is getting initially, because it's not the most difficult process to go through if you meet all the various educational and professional work requirements. We have individuals on our team that have that designation, and I've looked at it because I love continuing education, and why not add more acronyms behind my name?
Alphabet soup. There you go. So, all right, cool. So you kind of touched on this a little bit, but what are all the services that your firm provides then now?
Yeah, so primary service that we provide is working with SBA lenders, providing business valuation services as an independent third party, machinery and equipment appraisals, and feasibility studies for banks. One of the areas in business valuation that we wanted to focus on when we started Peak was education, because the value of anyone's business is a black box.
Mm-hmm.
And so we decided to focus on content. So articles like how to value an HVAC company, value drivers of an HVAC company, how to buy or sell an HVAC company, and just started focusing on these long form keywords. And now we have over 4,000 pages of content on our website, getting about 18 to 20,000 people a month coming to it. And so we get about 30 to 40 leads a week of individuals that are just genuinely interested about business valuation, whether they're looking to grow their company, and so they want to get an initial, like, what's the value of my business today? And if they implement X, Y, and Z strategies that they want to implement, looking at it the next year and the year after that to see kind of like a health checkup, how they're doing and progressing.
So you kind of take more of a consulting role in those, then yeah, that makes sense.
Yep. And then we introduce those people to coaches that can actually hold them and show them what to do and how to grow and potentially exit. We work with individuals that are looking to buy businesses that are generally concerned with the asking price, thinking, okay, based on the revenue, the proposed profitability of the company, the asking price is X, and that doesn't compute. And so they reach out to us and they want a independent opinion of what the business should be transacting at, and how do they go about then having that discussion with the broker or the seller from a negotiation standpoint. And that's one of my favorite activities.
Oh yeah, that's basically what I do all day, every day. Yeah. Yeah, looking at a write-up on a business or a listing and then trying to kind of pull back the onion and see, is it really listed how it should be? Is it selling off of a proper multiple? Are the ad backs accurate? All that stuff. Yeah, there's we could do 4 hours on that, I'm sure.
Oh, I love that part, because like, especially when you look at a listing, the listing's been around for 9 months, a year.
Yeah.
And you're like, hey, did you request year-to-date financials? And it's like, no, they just gave me 2022. And I'm like, oh, look at year-to-date.
Yeah.
You look at year-to-date and they're trailing on an annualized basis lower than they were in 2022. And I'm like, well, just based on that, you should write in your letter of intent, hey, I'm willing to buy the business for 30% below purchase price.
Yeah.
Because they haven't moved the listing. So it's fun. So other valuation services that we provide is we work with sellers who they've either identified someone to sell the business to. Primarily, they already have an employee at the company that they want to sell to, or they have a close family member that is in an associated business, or they work at that company that they want to sell to. And so we work with them to identify, like, this is what you should be transacting at from a value proposition, fair market value. But at the same time, this is how you go about legal and financing. So we will make introductions for them to legal representatives, which I just found out that if I present someone with a name for legal and a bank for financing, that there might be a conflict of interest with the legal team.
Oh, wow.
So I just found that out with you and Scott Oliver.
Oh, okay.
So So we help sellers out there to just kind of get them ready. What do they need to have lined up from not only a valuation standpoint, but how to get the buyer in a good position to feel confident in making that investment decision.
Right.
From there, all the other valuation exercises are more kind of industry specific, or not industry, but more kind of regulation specific. So gift and estate planning. So if someone's looking to transfer equity into a trust, or they're wanting to gift equity to a family member, like there are certain requirements that have to be met per IRS tax code that requires an independent business valuation to be performed.
Okay.
So we do a lot of gift and estate. The ones that we've started getting into more are a lot of divorce and partnership disputes, because those either are going down a path of mediation and hopefully a point of resolving and settling. But more often than not, we're seeing more litigation work.
Mm-hmm. Which could then obviously turn into liquidation and trying to figure out what to do there.
Yep.
Okay. And then as far as quality of earnings, are you doing that now? And maybe you can kind of give a quick overview of what exactly that entails.
Yeah. So a quality of earnings in its simple form is basically like you have your financial statement, so your profit and loss, balance sheet, and statement of cash flows. And the quality of earnings just opens you up to a clearer understanding of cash in, cash out, and what the proper structure of those financial statements should be and look like. And one of the main areas that is fun is when you're digging into general ledgers and identifying specific transactions or journal entries that have taken place, what are actually personal and non-recurring expenses, and identifying those in a much more formal matter than someone saying, hey, I went to Japan and spent $10,000, so that should be an add back. And it's like, well, where's the paper trail?
Yeah.
So quality of earnings, we have different stages of a quality of earnings, but at the end of the day, it's just providing typically the buyer a more kind of in-depth knowledge of the accuracy of the financials. And we work with some private equity firms from a quality of earnings standpoint, because once you get to a certain size of, let's say you're selling the business for $10 million, like, the buyer is going to get a quality of earnings, so the seller should have a quality of earnings, because if you're not coming to the table with the same numbers,
yeah,
then it just creates more dissonance and awkward conversations. So if both parties get quality of earnings and come to the table, it provides more of a constructive conversation.
Have you, while doing that process, I'm assuming you would, you're almost recreating the financials, right? So getting
Yep.
the bank statements and then going back and saying, did they put this in the right category? This is how they should actually look. Going through that process, what's like the craziest thing you've uncovered that you can talk about, obviously?
I don't really dig into crazy items.
No, I mean,
that
it's
are
like, have you
popping up.
found any fraud, or have you found,
because
that's essentially what
fraud
you're
and
looking
tax
for, right?
evasion are most common.
Right.
Finding expenses related to nefarious activities related to a mistress or some other party on
Wow.
the side. You're
Yeah.
like, oh, this is very interesting.
Yeah.
They're on your payroll. Why are you paying them? Like, what did they do?
Wow. Yeah. Oh my gosh.
Some of the coolest stories, though, is identifying in someone's financials that, like, they were allocating money to some sort of activity, and we found out that the guy had a private plane that he was expensing through the business, but it wasn't an asset on the business books.
Wow.
And he was in, I think he was a diamond merchant and had a storefront.
Yeah.
And I'm like, oh, that's cool.
Yeah. I remember that. So that's got to be interesting. I mean, you probably see all kinds of, I mean, we all see crazy things every day, but you really dig into the deals and uncover so many different things. We'll switch gears a little bit. So how many employees do you guys have now?
So we now have 13.
Wow. Okay. Cool.
So three of them are predominantly more on the marketing, the CRM, and the website side.
Mm-hmm.
And then the other 10 are purely focused on business valuation.
Okay. I know we could probably do a 3 or 4 hour podcast about how you value a business, but maybe what we can do is kind of break it down to a traditional small business. So maybe, somewhere revenue between 1 and 10 million, EBITDA of 100 grand to, 500,000-600,000. What's a normal kind of breakdown, just speaking to somebody that maybe doesn't have a good idea of how the process normally works? What do you do? What do you look at? How do you determine the value?
Yeah. So first off, the value of any business is what is a willing buyer, willing seller hypothetically transacting at. So that is formally known as fair market value. So our ultimate goal as a business valuation firm is to conclude to a fair and reasonable value that these two parties should be transacting at based on the knowledge that we have and our experience. So from a valuation standpoint, when looking at any business, at the end of the day, it's an asset. And that asset is spitting off cash flow. And that cash flow has a perceived risk associated with achieving it on a year-over-year basis. And so the primary place where we start is collecting financials from the particular party to understand from a financial standpoint all the quantitative figures about the business, going from revenue, digging through each individual expense to arrive at net income and assessing, okay, relative to industry, is this normal? And if it's not, we will inquire further as to, is this a personal expense? Is this a non-recurring expense? Why was this incurred? And once they provide that information, we can then start making adjustments to the financials to arrive at what is seller's discretionary earnings, which really that figure is what is the cash flow available to you as the owner of a business. And then we subtract out a replacement salary for the work that's being performed by that individual in the business. If they're the seller, or if they have someone if they're absentee, or they have someone that is actually managing the day-to-day, we'll adjust SDE to factor in that individual, because most individuals taking over a business are going to be operating that business. And so they won't need certain personnel. So adjustments have to take place in the financials, but we come to seller's discretionary earnings and then EBITDA, which is a mouthful of an acronym, but at the end of the day, it is in reference to the cash flow available to the business. So once we get there, that's pretty much like half of our analysis is just recreating what cash flow is for the business. And we then go from understanding the cash flow to looking at the various valuation approaches. And in the world of valuation, there's 3, so it's very simple. The first is asset, which most ongoing concern operating businesses don't look at an asset approach to assess the value of the company, because it's more of a liquidation scenario. However, we like certain businesses that fit that spectrum. We worked with a company from Idaho that is a septic tank well drilling company, and they had assets dating back to 1960. So we appraised their assets, and their assets, once we adjusted the balance sheet, because ultimately you have your balance sheet, which is assets, then you have liabilities and equity. In the asset approach, we basically look at the assets and say which assets need to be adjusted to what is fair market value. If they were to sell them today, what would they sell for? And then we look at the liabilities. Liabilities are dollar for dollar. Then we just take assets minus liabilities equals equity. And that's the asset approach in its simplistic form. And this company's assets, we looked at that, and the other approaches came in at a couple million higher than all the other valuation approaches, because the cash flow didn't justify the value of the assets.
So in a situation like that, it would make more sense for the business to just liquidate the assets than to try to sell it as a going concern business, where if a buyer looked at it and said, okay, I'm going to buy it based on what I'm going to receive in cash flow, that value is too low compared to what it's actually worth based on all their equipment. So at that point, it's like the seller either has to understand that they are selling it below what they can actually get by just liquidating the equipment. So then they have to kind of make that decision if it makes sense. So
Yep. And luckily, this individual was gifting equity to family members.
okay.
So it was a little bit different of a situation. Plus, it was cool to learn about a company that's been operating since the 60s with the same equipment that appraised is higher today than it did in the 60s.
Yeah, it's interesting.
So there's the asset approach. The market approach is the most familiar topic to anyone and everyone, because on a daily basis, we assess the value of assets, whether we're at a grocery store or we're buying and selling a house or buying and selling a car. We're placing a value on a particular item and agreeing to it. And it's a transaction. So the market approach from a small business perspective for this particular company is looking at other private transactions that are available through various databases and seeing, okay, let's say this company is an HVAC company. So HVAC company transacting in Phoenix, Arizona. Like, okay, let's look at transactions of HVAC companies in Phoenix, Arizona that have revenue between 1 and 10 million and a profitability of X. So setting criteria to kind of limit the number of transactions that kind of flow through that and seeing, okay, this company compared to these 12 others is very comparable. And so if it's comparable, we start then doing financial analysis and ratio analysis to determine, is the company from an industry standard below or above or below the industry? And if they're above, are they relative to these transactions performing better or worse than these transactions? And so through different math metrics, we then select the applicable multiples, whether it's revenue, EBITDA, or seller's discretionary, that are applicable to assess an implied value for that business. And I know based on your experience, looking at other private transactions is not the best way to assess value, because at the end of the day, we call it the guideline mergers and acquisitions method, or others call it the direct market approach. There's different names for it, but it's a guideline because ultimately there are a lot of criteria, information about these companies that we just don't know. So to make a direct comparison to your particular company that we have significantly more information on is difficult. So it's important to assess, but we have to bring in other methodologies to kind of back up and say, okay, what is happening in the market from a private transaction standpoint makes sense looking at other valuation approaches.
And then what was the third one?
Yeah, the third one is the income approach. The income approach is the one that gets the most complicated because you can look at, there's two primary methodologies. One's called the capitalization of cash flow or earnings, where you are essentially looking at the historical cash flow being generated by the company and assessing the risk or cap rate that is most applicable for that business. So going back to earlier, like you have your asset that's generating cash flow and there's a perceived risk. So that perceived risk in our world, we can capture in this figure called a cap rate. And we apply that cap rate to the cash flow to arrive at an implied value of a business. And the industry that correlates most relevant to cap rates is real estate. Because if you're buying a real estate property, if you're on
investment real estate,
you're looking at LoopNet or all these different websites, and they'll show, okay, you could buy this building for $1 million. This is the cash flow it's going to generate. Here's the associated cap rate. And so we're essentially doing that, but cap rate is kind of our unknown factor. And so we're trying to identify that cap rate for that business for what it's been able to do in the perceived risk.
So in most SBA loans, you're usually using more of a multiple of SDE, right? Which is based on comparables, which then you're kind of refining the comparables to see how closely they compare to the business. And then of course, every business is going to be a little bit different. So trying to, make a connection with real estate is really difficult. And a lot of people try to do that. And, a 3-bedroom, 2-bath house with a pool in a neighborhood is going to be fairly similar to the one down the street, unless it's had issues or maybe you hate the decor or whatever. With a business, there's so many different factors that go into play. It's not common for a business in the exact same industry to have the exact same profit margin. And of course, there's 30 factors that go into that. The employees, the length, what kind of marketing they're doing, all that kind of stuff. So that's probably where the biggest challenge comes, is trying to figure out which multiple to use. I know a lot of people seem to say use realistic SDE of maybe taking earnings before interest, taxes, depreciation, amortization, and then adding in the seller's salary and then using a 3 times multiple. I hear that all the time. How accurate is that? Yeah.
Oh, great question. I had this exact conversation yesterday with a guy who's looking at buying a physical therapy practice. And he's like, just give me a high level overview. And I'm like, it's kind of like me in your shoes telling a patient, hey, this is what we're going to do, without understanding their diagnosis.
Yeah.
Like
without doing x-rays, without.
You need the information about the business, the financials, to more accurately provide a number. But when I'm working with businesses that are just wanting something quick and simple, like I'll provide, because we value so many businesses per week, I can say, hey, for your business based on this, here's the range in the multiples, and go with those. But I feel like I'm doing a disservice. It's kind of like we received a letter from an accountant that did a valuation for a company that showed, it's 2 pages long, and it reads, we think your company, based on its historical cash flow, should transact at a 4 to 7x EBITDA multiple. And so it showed a range of 1.2 million to 2.1 million. And it's like, wait a second.
Yeah, they just grabbed a book
they had on that doesn't make any, how does that help you? And they ended up transacting lower than the 4 multiple.
Yeah.
So
which probably was accurate.
Yeah.
Yeah.
And so the 3x multiple, it's a good starting point to assess, okay, are they, if you're looking at biz buy sell and seeing all these businesses for sale, if you see, okay, the asking price is $1 million, the seller's discretionary is this, it's above or below a 3, let's say it's below a 3x SDE multiple, it's okay, that's a better business to look at. So I use it as more of a metric to start with,
right,
rather than conclude to.
Yeah, and I think that's kind of what I do as well when I'll get a deal right away, or I work with a lot of buyers that are trying to find something, and they'll send me the package from a broker, and usually I'll kind of take and look right off the top, okay, what are they saying the SDE is, and then the price, and I'll kind of quickly do the math in my head and say, okay, I'm going to have to really dig into this and see how they came up with that number. Of course, then it also goes by a lot of times who the broker is, right? I mean, I'll get some from a broker and I'll be like, I probably don't even need to look at this. They're very experienced, they know what they're doing. And I'll get some from other ones and I'm like, I'm going to have to try to dig into this, right? And that's just how the industry is. And then from there, I'll say, okay, give me the tax returns. Let me look at this, and I'll kind of go through. And I would say 70% of the time it's overpriced, or they're using add backs that we will not use, or that I don't even think a buyer should use. And there's various problems with the way people are valuing them. And I think it's a challenge for everybody involved, the buyer, the seller, the lenders, the brokers, trying to figure out where to list to get it sold.
Mm-hmm.
And, we also have it the other way, right? Where there's times I'm looking at it and I'm going, man, you got a really good deal on this. And then I get your valuation. I'm like, oh my gosh, like you've called me a couple of times and been like, why are they selling this so cheap? I'm like, I've asked them 7 times. Like, I don't know. So yeah, it's really interesting. Again, I mean, I think that's a really good broad overview of how you value the businesses. I always joke that everybody needs to stop watching Shark Tank because they look at it and they say, oh, well, that's this time's revenue, or they just throw out numbers. It's always boggles my mind when they ask them the question, well, what are you doing so far in revenue? And they'll say like, oh, I did $1 million this year. They'll say, okay, what's your margin on that? What will you net? I'll net $200,000. Okay, I'll give you $1 million for 5%. And I'm like, what are you doing? Like that business is worth like $500,000. Like, no.
Yep.
So yeah, it's real interesting.
So you mentioned Shark Tank. So back in April of 2020 or 2020, 2021, I was on the show The Prophet.
Yeah, Marcus Lemonis' show. Yeah, I remember seeing that. I texted you on like a Saturday and was like, hey, I just saw you on TV. And just laughed.
Yeah, and that one was a fascinating situation because the company was doing great from a revenue standpoint, but they were in such a hard spot from a cash flow standpoint. And that's because they had taken on debt to grow, but that debt was to a point where they had more debt than what the cash flow would ever support. And so they always needed more debt. And so Marcus came in, didn't know about the situation with the company from a debt perspective. They called us as the valuation firm, which I thought was the coolest thing.
Yeah.
And they're like, by the way, you need to do the valuation for free. And I'm like, cool. And so I show up on site because this is during COVID, like had to go through all the different precautions per CNBC's rules. And I show up and from start to finish, it's only 4 minutes long. And that's the only interaction I had with Marcus, but I had to present my valuation to him.
Right.
And it's like, oh, this is going to be awkward. And I presented the valuation to him at, I think, like a $10 million enterprise value. And he was hoping for me to say something significantly lower.
Yeah, and I was actually shocked when I watched it and you said that because, I mean, just we can't help but look at every single business and value it and everything in our heads. And when you said that, I was kind of like, wait, what? Like I almost called you like, Ryan, what are you doing? Like,
yeah, well, the interesting thing is you have all these debt holders. And so from the position of the debt, like there's a point of equilibrium where those debt holders are willing to either accept payment
right,
or convert into equity.
Correct.
And it's like, if the debt holders at this point own the company, so what are they willing to transact at? And so it has to be a number that surpasses the debt owed to them, because I think at the time they were making an annual interest of 15%.
Wow.
So from a return on shareholder standpoint, because that wasn't their personal money, it was assets under management that they had. Like, why would you ever convert
right
to equity if you're making that percentage?
Right. Unless there's going to be nothing there.
Yeah.
Right. So cool. Okay. Like I said, I mean, we could talk about this stuff forever. So I took a poll and tried to get some questions for you from the audience.
Oh, nice.
Had one which I feel like you've kind of answered a little bit. It came from Alan Peterson, who we all love. The question was, what makes your firm different in what seems like a really crowded space?
Yeah. Ooh, great question. So a couple of ways that we've tried to set ourselves apart. So within the world of business, everyone promotes NPS, so Net Promoter Score.
Mm-hmm.
Like, how well am I doing? And it's usually a number out of 10. And it's like, that doesn't tell me anything. And so instead, we've gone out and collected objective Google reviews from all of our customers. And so not everyone leaves one, but we have 410 5-star Google reviews based on services rendered.
Mm-hmm.
And so like that is a huge selling point to others, because they look at that and they're like, they can read the testimonials of what others have gone through and what they should expect to go through. So that's primarily one that we're known of outside of SBA. within the SBA world, it seems like a crowded space, but there's so much room because you go to conferences and you're like, okay, there's 12, 13 business valuation firms here, but I know of another 20 that work with all these other more smaller boutique SBA lending operations that are just individuals or other firms that like this is just one of their product lines. So within the world of SBA business valuation, like there are a number of individuals that are actually competing against each other. But I look at it more so from a collaborative standpoint because there's almost too much work that we cannot always do the work. If every bank came to us, like we couldn't fulfill it. So there's so much room for everybody else. But what sets us apart from others is when I first started, I worked at a valuation firm that they would tell bank lenders, hey, it's 10 business days to get this business valuation done. And I was a part of that process. And because I kept our annual operating plan, I looked at time spent on the engagement over hundreds of SBA business valuations over my tenure there. And I'm like, okay, if it takes this long to do a business valuation for SBA, why are we saying 10 business days? It's like you're working on it for a couple hours each day.
Yeah.
Like what happens if you take that and concentrate it in a shorter time frame and are able to work on it in 3 to 5 hour chunks per day? And it's like, oh, if that's possible, you could do a lot. And so when I entered the space, I'm like 5 business days. Yeah. And like we've had some banks that have wanted us to do it in a quicker time frame. And I'm now at a point where I push back because to do the quality work needed to get it done, like you have so many hours that you need to spend. And on the if you look at a bell curve, like, you basically estimate that every project is going to be like the median.
Right.
And so 5 business days works perfectly for us. If you now look at all the competitors outside the top 3, all of them are basically now promoting 3 to 5 business days.
Yeah, you changed the market. We thank you for that, by the way. Yeah, doing it, and that's one thing I think is a pretty good competitive advantage that the banks even can use by using you. Mm-hmm. We get a lot of times where we start working on the closing items up front, and I'm trying to really cut down the time. Everybody always says, time kills deals. So I try to continually refine that and get it done quicker and quicker and quicker. And one of the things that's kind of nice is people will come and they will say, should I order the report now when we're starting underwriting? And I usually tell them you have that option. However, it only takes 5 days. It's going to take 5 days to do several other things after we get the loan approved. So let's just go ahead and wait on that, not spend the money up front. If something happens in underwriting or your due diligence, you're going to be frustrated that you spent the money on it. So being able to say, it only takes 5 days, we can get it done, really helps the lender out as well. So
yeah, and like there are certain times like when the business valuation is ordered up front, mm-hmm. just to help individuals understand, okay, is what is being presented as the asking price supportable and legitimate?
Right.
And on those occasions, because like what I love about working with SBA lenders is a majority of the documents and the questions that we already ask outside of SBA to one-off individuals, like the bank is collecting that because debt underwriting is just on the other side of a coin from business valuation. Like we're both looking at the underlying cash flow of the business.
Exactly.
So like because you're already addressing all these questions, it can shorten time frame. But at the same time, when the business valuation is ordered before underwriting, like we are more detectives digging into all this information. And sometimes it's great. Sometimes we reveal information where it's like, hey, the seller presented this business, but within this business, there are 2 other businesses and they're only buying one. and are only looking at the tax returns. And so we will value the business, present our findings, and put a list together of this is why we valued the business at what we valued it at.
That makes sense. Yeah.
And some bankers are like, that kind of stinks. Others are just appreciative.
Yeah, definitely. I mean, at the end of the day, if a good lender should want the buyer to be successful when they're done. And if they're not going to be, or there's any kind of doubt, they should be stopping the process and saying, hey, don't buy this business, or let's restructure this. Let's work on it. Let's see what we can do to make sure you're not putting yourself in a bad spot. I mean, at the end of the day, you do that too many times and you have no credibility with your bank, and then, nobody wants to work with you. So, All right. So the next question was, we see a lot of listings that include the value of the business based on the SDE, but then the broker on the listing is then on top of that adding inventory or equipment. I get this a lot. I have a lot of disagreements with the brokers on this. Maybe you can give me your opinion of how that should actually be valued.
Yeah, this is one of our most common questions too. It's like, well, we have all this equipment. It should be added to the value. And it's like, well, let's use a common example. You have someone who's coming to mow your lawn. They have to show up pretty much with a truck, and they're going to pull out a lawnmower from the back of the truck. And then they're going to perform their service. You pay them money. So that whole interaction, what did you need? You needed a truck and you needed a lawnmower. Without the truck or lawnmower, you can't mow a lawn, and so you can't collect revenue. So like your equipment is in place to help you generate revenue and therefore cash flow.
Yes, thank you.
So
I can die happy now. That's one of the biggest arguments. And same thing with inventory, right? The way I always explain it to somebody with inventory, and I don't want to steal it from you, but I usually tell them, like, you cannot create seller's discretionary earnings if you didn't have something that you made that you can sell or that you have to sell. So the sale should include a normal amount of inventory. The same with the equipment necessary to produce the income, to produce the SDE, which gives it value. And that's always a tough thing to get especially the brokers to understand, is they say, oh, well, it's, a 3.5 times multiple of SDE, and then $300,000-$400,000 in inventory. And I'm like, no, if you take away the inventory, you don't have the SDE. Same thing with the equipment, right? So
yeah. And like it's really, with inventory, it's like industry specific, whether or not it is additive or you only add what's considered excess, because you really do need a normal operating level of working capital, which includes inventory.
Right.
Because if you didn't have that inventory, and let's say your lead time from when you put in the purchase order to when you receive the inventory is 4 weeks, like you got to have 4 weeks of inventory on hand. If you don't, kind of like you look at liquor stores, it's kind of the most common example of where inventory is more so additive, is because the lead time on receiving that shipment is significantly less. Because there's distributors and warehouses within like a 50-mile radius that can supply that store with what you need.
Right.
So
it's much different than when they're making the actual inventory.
Yeah, when they're making the actual inventory, it's like, one, you got raw materials, you got work in progress, and you got finished goods. Technically, everything that is a work in progress, like, that shouldn't be added to. Like raw materials, you can make a stronger argument there. So, but yeah, it's really business by business what is appropriate.
All right, I'm going to cut that piece up and I'm going to start emailing it to people. All right, another thing, you did cover this a little bit, but maybe you could just throw out like one or two quick things. What can a seller do 24 months before they want to sell to increase their value?
Oh, great question. The first thing that I think you would agree with is hire a bookkeeper and make sure you have someone going through your financials. Because if your financials are not in order, like you can't sell your business, because that's the first area that people, they want to look at. And if they start asking questions, then it's like, okay, if you don't have an answer to that question, like what else is wrong in your financials? So your financials will impact not only the value, but how long the process takes to sell your business, and whether or not you're actually going to get a buyer that will come to the table. Because a lot of brokers that we work with, like I have a buddy here locally in Salt Lake, and he's like, if the financials are not in order, like I won't even look at it.
Yeah.
Because I got to interpret what they've done. And that's why a lot of individuals will order a quality of earnings, because there's something about the financials that don't look right. And so there's a lot, like you don't want skepticism with your financials. So that's the primary area I would focus on.
Okay, thank you. Yeah, I definitely agree with you. Another question that a lot of people brought up, there's always kind of this personal expenses thing that goes on. And we get a lot of sellers saying, hey, you got to kind of work with me here. My spouse runs all their Amazon expenses through the business. I use all my vacation. At what point do you, I guess more of the question is there a line in the sand where you're saying, I will include this in the valuation, even though it's tax fraud? How do you kind of determine, is that part of the SDE? Obviously as SBA lenders, there's kind of a gray area there as well, where we're saying, I understand that you did all of this. We're not disagreeing that there's probably a higher amount of discretionary earnings here. However, at what point are we rewarding a seller for committing tax fraud and by also giving them the value so they can sell the business?
Yeah. So when it comes to add backs of personal expenses, like one of the areas that we try to focus and collect is a paper trail and documentation of those personal expenses. And then looking at the financials after we have the personal expenses laid out and looking at it from that same definition of fair market value, willing buyer, willing seller. Like is it normal for an individual in this industry to incur that expense? And if the answer is yes, then it's not an add back.
So an example would probably be auto expense, right? Their car payment and maybe their gas and car insurance is fairly normal for almost every single business, whether they need the vehicle to operate and drive around and check on the business or deliver something or whatever. Most of the time, you're still going to see auto expense in one way, shape, or form, right?
Yeah. Like for instance, if you're a contractor, like a lot of contractors will have all their family vehicles in the business.
Right.
And so like the truck that is used by the owner is primarily business oriented. Like if you have branding on the vehicle, that's business. But if there is a Tesla Model S, you know that that's a personal vehicle. Or my favorite is I think it's a Toyota Odyssey. So a minivan.
Yeah.
And it's like, okay, that's obviously a car that someone in the family owns. That's not operational in the business. And so like you could kind of go through and you can see like what is actually a personal expense. A lot of the gray area comes down to expense items that are business and personal. So like meals and entertainment. It is so hard to know what truly is personal.
Right.
And what is truly business. And so there we look at like industry data and say, so there's a cool company called BizMiner that has direct access to all of the financials the IRS reports for tax purposes. And so you could break it down and look at a plumbing contractor in Dallas, Fort Worth, Texas that is doing like $500,000 in revenue. And so it pulls up and shows there are 180 data points, and these are their historical financials for the last 5 years, and here's the aggregate average.
So then you can determine whether or not their auto expense is normal or, or meals and entertainment.
Or like a retirement plan, like pension and profit sharing or employee benefits.
Right.
And so like we focus more so on the expenses that we can truly assess and see and strip out and say, this is personal. Like a lot of contractors will do repairs on their house, or they'll remodel
or their own business.
And so you're like, okay, provide all like the receipts, documentation, and just show me.
Yeah.
And they could show it to you, and like those are easier to take into consideration,
right?
Than like
and
let's use
straight fraud buying your spouse a new Louis Vuitton bag. Yeah.
Yep. or individuals, like going back to that liquor store, like a lot of liquor stores will have what sales reported in their POS,
right,
from credit cards, and then they have cash receipts.
Yeah.
And for one reason or another, the cash receipts never show up in the tax return.
Yep.
But when it comes time to selling the business, they're like, oh, here's an additional $300,000 in cash collected that should be a part of revenue. And it's like, did you report it to the IRS? And they're like, no. And it's like, well, then you can't eat your cake twice.
Correct. Yes. Thank you. So yeah, we could probably talk about that forever. So another question was, should equality of earnings be required by the SBA?
Oh, that is a great question. I've never thought about it. In some respect, there are companies that should always look at equality of earnings.
What would be an example of that?
So like if you're transacting at like $3 million, like you can almost look at it from a threshold standpoint.
Right.
Like your business is a little bit more complicated. And so therefore you should recreate and dig into the financials more. However, like
so maybe putting a threshold on it would work. Like
a threshold will work.
3 million, something like that.
But like there are individuals in the world of TikTok, YouTube Shorts, Instagram Shorts that are pushing like, hey, if you're looking to buy a business, like I've done this for every business that I bought, you get equality of earnings. And I will have people call me up and say, hey, I'm buying a business for $1 million. And so said that I should get equality of earnings. And I'm like, okay, there's one bank account. There's one company credit card. There's 5 vendors. You have 3 employees. Like you personally could look at the financials, look at their QuickBooks, and see if there's anything weird
3
going
months
on.
worth of bank statements. Yeah.
Yeah. Like it's not that difficult. It gets difficult when the company is larger. You're dealing with, so like our water softener company, we have over 4,000 customers.
Oh, wow.
And so that means you have a lot of small transactions.
Right.
And so it's like, how detailed and minute do you want to get in digging into cash in, cash out, reconstructing the balance sheet, the P&L? So that's a hard one.
Yeah. So
like,
maybe it's a threshold. I don't know. I mean, you kind of hope from a buyer's side that it's like playing with fire, right? Like it works. It makes sense. It probably could save some deals from going bad down the road. Maybe limit some fraud. But then you're adding another expense. Another thing for someone to do. Everybody already complains how long it takes to get an SBA loan, so it might just turn to be more prohibitive.
And with the quality of earnings, like they are sometimes great. There are firms that do a phenomenal job with quality of earnings, and other firms where you look at their quality of earnings and you're like, this doesn't help.
Yeah, they spent money for nothing. Yeah.
Yeah, and so like there has to be a level of standards, but right now there really aren't standards because everyone has, this is what we're going to do. So for instance, the Seal Masters franchise that we're looking at acquiring, the individual that we're going to partner with to buy it wants to get a quality of earnings. So we got a quote from someone and their presentation was beautiful on why you should go with them and why their pricing was what it was. And I just emailed him with, hey, this is what we're going to do. This is what we need. And like, I don't dress it up because quality of earnings at the end of the day it's just ugly.
Yeah. Well, and that's what's funny about business, right? I mean, I get that myself where people say, well, there's, 3 lenders that I'm talking to, like, why should I go with you? And or they get frustrated because I just send them a needs list. And I'm like, do you want to talk on the phone? Do you want to do anything? And then I guess part of it is we get so busy that you kind of lose that crazy presentation that you want to like completely woo somebody. And I usually just tell them at the end of the day, like, I know what I'm doing. I probably do more transactions than anybody. Like, I'll get it done. I've done this myself. I've bought businesses. I've got an SBA loan for buying a business. Let's like, and then usually they'll kind of calm down. Whereas then you get the ones where they're, oh, well, we sponsor everything and we advertise. We're the biggest SBA lender in the country and this and that. And it's like, at the end of the day, like it's really difficult to figure out who to go with. But I could see where that person would say, well, their thing is pretty and it drew me to it, so.
Yeah. And I'm like, at the end of the day, what do you need? You need something functional. Like a PDF report is great.
Yeah.
But I like sending people the actual Excel file that we put together and built.
Right.
Because one, if you're going to a bank, the bank's going to love having the Excel file.
Yeah.
Because then they just add it to their Excel file and just link.
Yep.
The PDF is great, but then you start questioning, where does this number come from? So you're having to like follow and go back in pages. Whereas in the Excel file for equality of earnings, you could just hit control back bracket and you see the source where it came from.
Well, we're not all Excel experts like you, but so, all right, let's do two more. What is the biggest gap that you've done with a valuation between what you appraised it as and what it sold for, both ways, so high and low?
That is actually very difficult to know, just because like if we're dealing with SBA, like we're part of the process, but we're just part of the process, so we don't know whether or not it actually closed.
Okay, but from the purchase agreement that you received to the valuation you did.
Yeah, so a recent one that we just worked on, they were transacting, so it was a convenience store transacting at about 1.3 million. We came in at 230,000.
Wow, that's a big difference.
Big difference, and reason being is
they
had add backs galore.
Yeah,
they were the actual, and this was a one-off scenario, essentially. Between the add backs, at the end of the day, it was still transacting at like a 6x SDE multiple, and you're like, that doesn't make any sense. And the guy was like, I know it doesn't make sense, but I want you to put it in, do the valuation, so I have something to present to the business owner and say, hey, look at this, look at the logic.
They can blame it on you. Yeah.
Yeah. Well, at the end of the day, like business valuation, like I'm happy to be the bad guy.
Yeah. Well, that's a weird. The lenders get that a lot too. So yeah.
Oh, I bet
that's an SBA rule. It's not my fault. Sorry.
Yeah. And kind of on the upside, we've worked with companies that, let's say, well, I'll give a broad example just because I don't know specifics off the top of my head, but individuals who are selling businesses that are selling to a key employee. And they have such an admiration for that key employee and understand kind of what they did to help grow the business, that they're willing to sell the business for half of what it should be transacting at. Because they want to set up that person for longer.
It's kind of like they built in the equity, right? So, So technically, the way I love those deals. I always think it's really cool when they do that. Sometimes the challenge is getting the bank to be comfortable with it, because 9 times out of 10, that individual doesn't have any kind of net worth because they've been either underpaid or they're not making the wages that the owner of the business has been making, but they've been essentially operating or running the business. I get really frustrated when credit looks at that and says, well, I don't like this buyer. And I'm looking at it going, the biggest challenge you have in a change of ownership on the business is the change of ownership, right? So the person coming in to buy the business could have this crazy cool PFS, have tons of liquidity, but if they don't know how to operate that business, or they don't know how to deal with people or the vendors, or they don't have the qualifications for it, I'm more worried about that person than the guy that's been the key employee for 10 years that unfortunately hasn't been able to save because they're making 50 grand and live in San Diego. They don't have the money to put down on the business, right? And then that person, the seller, looks at it and says, this guy has been, basically underpaid for 10 years. So now I'm going to give him a $500,000 reduction on the sale of the business because they've earned that, right? I mean, I love those deals that they make me happy that this person worked hard and got into it, but then sometimes we get frustrated with credit because they're like, oh, they're not a good borrower. And it's like, no. So yeah, so we see those. I think the craziest one I've seen, I want to say it was about $8 million in the difference between what they bought it for and what you came in at on the value.
Dang.
It was pretty crazy. So
the most fascinating deal, going back to that scenario where the contractor stopped selling and so the WIP went to zero. So the initial asking price was around $2.5 million. They were transacting at $1.5 million. When we found out that there was no WIP,
they essentially closed the business down, right?
Like there's still value associated with it, but like it dropped to the low 100,000s. And the buyer, like the buyer still wanted to buy the company because of the relationships. So there was perceived value, but the seller looked at it and was like, oh, I'll go back to selling and we'll transact in 6 months. And it's like, do you want to revisit this acquisition in 6 months?
Yeah.
Yeah, it's weird.
Yeah, it happened. So, all right, we'll do one more. Where do you think that the industry is headed with what you do? Do you think AI is going to have a big part in it? Whatever you're kind of thinking is going to happen in the next 5, 10, 15, 20 years?
Yeah. Ooh. Well, 20 years, I have no clue. Just right now, from an AI standpoint, when it comes to like we use AI in our process from the standpoint of like writing footnotes and taking into account like industry and economic information. There are tools that are being built out that we could have access to that would do phenomenal research for us. But right now we're just testing them. But there are a lot of elements that AI will replace, but more so it'll enhance what we do. Because at the end of the day, I have a great job because I get to sell my opinion to others.
Yeah.
And so it is the professional judgment that ultimately influences the conclusion for that business value. And so AI can replace a lot of the actual building of the Excel model, the writing of the report. But at the end of the day, like you still need someone to provide that opinion and will stand by it. So like there's a lot of, I think someone tried to present in an IRS tax court case recently, valuation report that was primarily like Chat GPT produced.
Mm-hmm.
And it didn't go anywhere.
Yeah.
Because like we have to be able to essentially die on the hill by our opinion.
Right.
And so we got to support it. And if there's reasoning as to why there should be a change, like we have to be able to take that reasoning and make adjustments to what we've produced. And so it's a lot of collaboration. And so AI will replace a lot of what we do, but the actual judgment collaboration part won't disappear.
So it's almost like it'll maybe speed up the process or aid you in the research, eliminate some manual work.
It's kind of like you look at our Excel model, and we've tried to automate it as much as possible. But I personally love manual work.
Yeah.
Because there is a lot, like for instance, entering financials, like you could get access to softwares that will just spread it for you.
Right.
But when it's the entering of the financials where you look at and you see, oh, that is a weird expense.
Yeah.
Like, why is that 10% of revenue? And so like you start, like you're doing analysis while you're entering data.
Yeah. It makes you ask questions as well. That's what I've liked. Sometimes I'll get so busy that I can't give 100% on a deal, and I'm like, I'll look at it. The numbers work, the individual works. Okay, kind of slap it together and send it to credit. And then the underwriter called me, hey, I have questions for you. And I'm like, uh-oh, this one I didn't like really dig in and look at all the numbers. And I mean, we still usually are fine and I can jump in real quick from doing it forever. But I do like the process of looking at it because while I'm doing it, I'm usually asking questions at the same time to try to understand it a little bit better. So it's interesting. So, all right. So my final two questions that I always ask, do you have a mentor? Have you ever had a mentor?
Yeah. So I have two primary mentors. My first is my father, because he joined an individual named Mike Novogradic in 1989 and built an accounting firm that when he retired had 750 people.
Wow.
And so from the standpoint of not only being great as a dad and a husband, like he's a mentor for my personal life, but from a business standpoint, I always have someone that I can go to and talk to and ask questions about how did you do this? How did you think about compensation relative to years and experience? And then from the standpoint of just having someone to bounce ideas off of, I have a good buddy, his name is Dave Hinckley, who we randomly met by introduction of my business banker when I started.
Oh, wow.
He's like, oh, you should talk to this person. So we scheduled an appointment, met for lunch, and we've been friends ever since. And so we bounce ideas off of each other, have tried to start businesses with each other, but they're more concepts. And now actually with our water softener company, we have a management agreement with them.
Oh, cool.
Where his team is managing day-to-day operations, and if they hit X, Y, and Z KPIs, like this happens. Like it's so like we're doing stuff with him in collaboration. He's taught me a lot. So
that's awesome. Yeah, sometimes you meet people in a weird way and it just works out. So that's great. All right, last question. You are obviously motivated. You get up at 3 a.m. You keep taking on more and more things, looking at so many different ways to improve the business and find new businesses. Like why? What motivates you?
Oh, great question. Ultimately, I've always loved creating and serving. And so from the standpoint of building Peak, I got to a point with my wife, Kelly, where we looked at the business and we're like, we're doing really good. Like if we wanted to, we can provide a living for someone else to join our team. And it's like, oh, that would be kind of fun. Let's try that out. And so now we're at a point where we're providing for the livelihoods of 13 families. And then all the other businesses, same thing.
Yeah.
And so like that's how I look at it, is I'm helping them provide for their families and build what they think is their ideal financial situation. And so that's what I enjoy. Like I have an employee on my team. So every week I meet with every employee for 15 to 20 minutes and just chat with them about life and ask them, hey, what questions do you have about what you're doing? But where do you want to go? So like I had one employee that was like, I want my wife to not work for this pay for this many hours per week. And I'm like, perfect. I'll just raise your salary to what she was making. And he's like, oh, that's awesome.
Better hope the other employees don't listen to this.
Oh, well,
I'm just kidding.
Yeah.
But yeah.
They know.
Deserved it. Yeah.
They deserved it. And then I have another employee that really wants to like be part of the team long term. And so we're actually looking at other valuation firms to acquire where he would be a partner in. We have other, so, and the like, I want to create equity situations for my team. I have a business consultant that I work with in Tulsa, Oklahoma. His name is Clay Clark. He has a business partner called Dr. Zellner that started his business in the optical like industry.
Mm-hmm.
And all of his doctors that reach a certain tenure are basically stuck making X amount of dollars a year. However, because they've been with him that long, they now get profits interest in an entity that has equity ownership in all the other dozen companies he owns. So now those people are making more money from that investment than at their current job. However, there is a stipulation in their contract where if they don't remain working with them, like if they quit, all that extra money disappears as well.
Yeah.
So it's like a great incentive, and it's like, oh, that would be cool. So I'm actually trying to build that same process so that everyone on my team wants to stay because the work is fun and enjoyable, but can make more money because of the success that we're having. They're helping us build that success, and because we know what we need to do to like build businesses and grow and make more money, we're able to pass that along to them and help them in their careers and what they want to do.
Yeah, that's awesome.
Yeah.
Yeah, you're only as good as the employees, so taking care of them makes sense. Yeah, and you've got some great employees. So, it's been great. I think we might have to do another one. I'll get some more questions, maybe a year from now or something. We could talk forever.
I'll go to Texas.
All right, sounds good.
There's I guess Malk conference is in Houston.
Okay, well, maybe I'll come down there and
hopefully see. I was hoping for Dallas.
Yeah.
Or Austin, not Austin, Waco.
Okay. Yeah, they get a lot of people that go there. Yeah. All right, where can people find you?
Yeah, so people can find us by visiting our website, peakbusinessvaluation.com, or all they have to do is call, so 435-359-2684. If they love LinkedIn, I post profusely on LinkedIn. So I write for 30 minutes a day, and then I schedule them out throughout the day.
Yeah, that's great information you put out too. I always appreciate seeing it. So thanks again. I really appreciate it.
Oh, welcome. Thanks for having me, Jared.
All right, of course.
Thank you for listening. We hope you found this podcast informative and helpful. Please don't forget to subscribe on your favorite podcast player. For more information, or if you'd like to discuss a transaction, please go to www.jaredwjohnson.com.